Hello and welcome to a Finimize Modern Investor event where we bring in experts from across the industry to help you become a smarter, better, more informed investor. I'm Carl Hazeley, CEO here at Finimize, and I'm delighted to host today's session. It's super timely. It's called What's Really Driving Crypto? And it's brought to you in partnership with CoinShares, again, as part of this Modern Investor Community Series. CoinShares is Europe's leading digital asset manager. CoinShares pioneered cryptocurrency ETPs, exchange-traded products, back in 2014, and as a company is listed on NASDAQ Stockholm. They've been at the forefront of digital assets ever since. Now, no finance event is complete without the disclaimer. Repeat after me. Your capital is at risk. This is not financial advice. Tax treatment depends on your individual circumstances and may be subject to change. And scene. Now, before we dive in and before I introduce Chris, you'll see a poll on your screen. Please take a quick look. Cast your votes. I think you'll find it very illuminating as we get into the conversation. And with that, it's my genuine pleasure to introduce Chris Bendiksen, Bitcoin research lead at CoinShares. Chris has got over a decade or close to a decade, give or take, experience covering Bitcoin fundamentals, valuation, mining, all its technical underpinnings. So we're going to spend a lot of time on some of that today. Chris, welcome. Great to have you here. How are you?
Thanks for having me. I'm doing good. Thank you.
Awesome. Let's get right into it. We're in a pretty turbulent period in markets broadly right now. I think that's possibly the understatement of the week. But in that context, how do you think about Bitcoin and the wider crypto markets during episodes of elevated macro volatility? And maybe related, is crypto as a safe haven as people had thought of it? Is that thesis being tested? Is that holding up?
Well, we can start with the second one. So crypto as a whole is not a safe haven.
Okay.
And I don't think anyone. I mean, it's quite a broad sector. There are certain assets within the sector that have qualities that would make it suitable to become safe havens, such as Bitcoin, at some point in the future. But getting there is a process. You can build an asset to have certain qualities, but it requires time in order for the market to kind of cement something as behaving in that way. And that kind of gets us to the first question that you asked, which is how things are behaving in relation to the macro environment right now.
Yeah. And
it's important to remember that any asset's price behavior is the compound behavior of every person who's involved in the market. And so it's a collection of different beliefs and behaviors that people have about an asset that will determine how it behaves during certain times and during certain conditions.
Yeah.
So at the moment, Bitcoin, and I would say part of the wider crypto ecosystem as well, is not moving so much in lockstep with the kind of wider macro world as it has done at other times. I think this is because we are at a market slump, if you will.
Okay.
And so the proportion of market participants that I would consider kind of the speculative type of tourists, if you will, the proportion of participants that fit that category is probably at a cyclical low at the moment. And so the people who are kind of still in it, if you will, are people who either know what they have and know what they own and have certain expectations about it that they don't need to play out over 3 to 6 months. They're happy to take the long-term view. And in periods like that, Bitcoin and crypto tend to do its own thing. It tends to play by its own book, and it tends to just move in accordance with its own fundamentals more so than kind of take cues from the rest of the market. If you zoom back about 1 year, the situation was quite the other way around.
Yeah.
We were at I wouldn't say a roaring bull market. It was quite a boring bull market as they go, but bull market nonetheless. We were at all-time highs. Transaction volumes were spiking. Lots of public interest. U.S. presidential administration, all this talk about strategic Bitcoin reserve, all the works.
The stars were aligning.
Yeah, exactly. And so at that point, you get a high proportion of market participants that are of the speculative, like trend riding, momentum chasing kind.
Yeah.
And they will tend to treat it in a much more of like a shallow risk on, risk off way. So during bull markets, Bitcoin's much more susceptible to correlate with wider kind of risk on, risk off animal spirits type movements.
Yeah.
But that's not where we are right now. Right now, we're kind of in like a boring Bitcoin's like kind of dead, and the only people who are buying it are like high conviction, long term type oriented people. And when that happens, it just tends to grind. And so yeah, and will it become a safe haven? Maybe someday. Some people treat it as such, but it's not. I wouldn't say that it's like a majority or close to.
I think I've maybe seen the argument that it's a safe haven that Bitcoin is a safe haven within the crypto world, but I take your point that it's
everything is relative.
It's a macro. Sorry, if you take a macro view, it's a risk asset.
Yeah, well, it's for as long as we're on, if you ask 100 people, you get a lot of different answers about what Bitcoin is and where its place is going to be in the future financial system. And so long as there's disagreement about that, there will be price volatility and price discovery.
Well, exactly.
And so until there's a more widespread agreement, people kind of agree that gold is a safe haven, right? It's been a safe haven. It has a really long history of being so, and people behave as if it is. And Bitcoin needs a lot more of a track record over time, but every time we see through these type of market cycles with large scale corrections, and we rebound and we continue grinding up, I think more and more people kind of take on board the potential that Bitcoin has and the qualities that it has, and its ability to do certain things for them that they want.
I mean, that's super interesting, and it tracks with our own data in that we've seen a slight but noticeable drop-off in the proportion of people who say, look, I'm going to invest in crypto in the next 6 to 12 months. However, the people who are continuing to hold Bitcoin, 2/3 to 3/4 of them see it as a long-term holding. They're hunkering down. Some are even, buying the dip, as it were. And it's exactly as you described. But I want to maybe pick up on something you just mentioned a couple of times there around time. And again, I guess there's it's historical, maybe it's a little bit current, this conversation around Bitcoin and cycles, and arguing that there's arguably a 4-year cycle linked to halving events and so on, and some investors do try to time that and maybe start Bitcoin starts looking a bit more interesting later this year on that basis. I mean, does that track with your experience? Does that map to what you've seen historically? And is that even a good way to think about things?
I mean, historically, there's no doubt that there have been cycles, and they've been 4 years, like on the dot, even this time around. The cycles are dampening, though. And I think playing the halving into it, the halving is a dampening. It has a dampened continuation to it. Okay. And so every time there's a new halving, the impact that it has on the market in terms of flow reduction is smaller than it was last time. Half as big, right? Which is quite a substantial magnitude. So I think the impact of the halving itself probably was largest the first time, and then still quite impactful second, third time. I think it'll start being less and less impactful as the kind of proportion of new coins coming to market from miners versus the total traded volume and the total amount of coins that are released by existing holders just gets smaller and smaller.
Gotcha.
I would be careful. Remember, we have 3 data points.
Yes.
So I would be very, very careful to, keep it in mind as a thing. In markets, there are such a thing as self-fulfilling prophecies.
Yeah.
So, to an extent, keep in mind that other people might believe this, but I wouldn't make it a core part of my thesis. I would just keep it in the back of your mind as something that has happened before and could happen again based on belief. But I think in terms of like the market impact of the halvings directly, I think those will become kind of minuscule as we go forward.
That is interesting and good to know. You talked about core part of your thesis. I think we might come back to that. And if I don't, I expect some people might ask about your core thesis in the Q&A a bit later on. Please use the Q&A chat box and we'll pick up the questions shortly. But I want to switch gears a little bit, Chris, because another thing that we see in the data, and this is why I'm so glad that we're having this conversation, is that a lot of investors do want crypto exposure and do have it via exchange, but increasingly are less comfortable holding directly or holding, via exchange, and exchange traded products, ETPs, are becoming a bigger part of the mix and a more popular route. So can you just maybe level set everyone watching and listening here and just walk me through how an ETP is actually structured and what are the risk considerations for me as someone looking to buy?
Sure. There are 2 main ways that ETPs tend to be constructed in the crypto sector. One is a swap-based debt instrument, and the other one is what's called a physical ETP.
Okay.
I'll just go quickly through the swap-based one because it's a very uncommon way of structuring these days. It was more common back in the day, like when we first got started. So basically, a swap-based ETP is a note that's issued that is a debt instrument that is held against the balance sheet of the issuer, amounting to a certain amount of crypto. Or a certain dollar-based amount calculated against an index.
Right.
And so the main risk that you have there is that the issuer isn't properly hedged, and when everybody wants their money back, their balance sheet can't handle the necessary outflows.
Yeah.
So this is part of the reason why most issuers have switched to the physical model, and the physical model is different. So in the physical model, there's still an issuer that issues a security that entitles the holder to a certain amount of the underlying crypto. But that issuer is separate from the actual custodian that holds the crypto. So the way the mechanism works is that the issuer is sent, let's just use Bitcoin as the example. So the issuer is sent Bitcoin. Upon receiving Bitcoin, they issue these securities in the same amount of the Bitcoin that they received. That Bitcoin then goes to a custodian. This custodian is not part of the issuer. So they're a separate company, and the actual Bitcoin that sits with the custodian has an ownership trail that goes all the way back to the note holder. So it's called a bankruptcy remote structure. So even if the issuer goes bankrupt or whatever happens to it, the coins are still with the custodian, and note holders can turn in their notes and get their either dollars via exchange, or in some cases they can get their Bitcoin directly if they're large enough. Okay. So it's basically a way to get price exposure without needing to actually hold the coins themselves. So the coins are held with a qualified custodian somewhere else. And so you don't need to deal with any of the technical problems. It's also much easier. And, there are a lot of hoops that people have to jump through these days to hold physical coins themselves. The EU in particular are trying to make it very difficult for people to withdraw coins to their own addresses. There's like KYC requirements, all of this stuff. So the ease with which you can get in and out through a regular broker, for example, is like a huge benefit. And the fact that you have professionals dealing with the custodianship is also a big benefit of this type of structure.
Okay, I'm going to come to the questions because they're starting to build up, but I just want to squeeze in one more if I can,
Sure.
Which is, again, if I go rewind the last 3 years, AI has been the second word in every conversation and often the fourth and the sixth. And quantum computing is a part of that, and that keeps coming up in the conversations we're having and seeing around crypto and around Bitcoin. And on the one hand, it feels a bit abstract, but it seems to be this sort of Damocles sword hanging over part of the crypto industry, at least. Can you just help us wrap our heads around the potential threat of quantum computing to Bitcoin, let's say, if any, and what's your view on time horizons and how seriously should we be taking this?
Sure. Well, we should be taking it seriously. But to me, it's maybe like a top 3 concern that we have. Maybe I'm a little bit too close to how the sausage is made in terms of the development community, but I'm acutely aware of all the other issues that Bitcoin in particular constantly has, and that we need to fix. I would probably, there are a lot of things that can go wrong that would be on the order of the same level of calamity as the worst possible quantum outcome. For example, like a disaster at one of the large exchanges like Coinbase or with MicroStrategy or things like that. People who hold millions of Bitcoin. And so with quantum computing, this is a potential threat, but it's quite distant and quite abstract as well. And it will require some changes, but you can already protect yourself quite well just within the existing address frameworks that Bitcoin has. If your coin is sitting in a modern address, which anyone who's buying a Bitcoin today will have their coins in a modern address format, it's not under threat by quantum computers anytime soon. And it's a little bit hard to explain in a quick, succinct way, but your coins would only be under threat in an extreme scenario of basically like overnight development of quantum computers that have like almost like superpowers. It would be many, many orders of magnitude beyond where we are right now, and these require like hard engineering problems to be solved.
Gotcha.
So, watch it. Like, it's definitely a thing, but there's nothing to panic over. It's something to keep an eye on, and just make sure that if you're interacting directly with, for example, the Bitcoin blockchain, then you need to exercise proper hygiene. Like, don't reuse an address. Make sure that you are in a hashed address format, things like that. And then there are things that we can do in the future, like introduce new quantum secure address formats. But there's a lot of research that needs to be done there. And I would say that the risk of us getting the fix wrong to the point where the fix actually creates a disastrous security problem is probably an equally large problem as the quantum computers themselves.
Well, that's interesting.
Yeah, we got to keep in mind that every cryptographic system that has failed to date has failed to classical computers. And so we got to make sure that if and when we put in a quantum safe new cryptography, that cryptography is actually safe against regular computers.
Yeah.
And so there's a lot of research and testing that needs to be done. And so it's dangerous to be hasty here as well. So, I mean, I lose no sleep over this myself.
Okay.
But, it's still something that I discuss frequently with people in the technical community. And I, now it's more than half of the conversations on the Bitcoin dev list, the email list. So it's definitely being taken seriously.
Okay. Well, that's good to know. All right. Let's get into some of your questions, Finimizers. We're going to start with Julian, who is a man after my own heart because he's getting towards what your thesis might be. And he says, my view is that you don't buy Bitcoin for performance. You buy it because you believe in its long-term virtues as the world changes environment, blockchainization of the world, etc. I guess not a question, but maybe, from your experience, how big a thesis or how strong a thesis is that, if you don't mind commenting?
Look, everyone has their own approach. Bitcoin has a lot of qualities that lends itself towards that thesis. A thesis of independence and of individual empowerment, things like this. Bitcoin is one of the most powerful technologies ever invented, in my opinion, and it will unshackle the individual and protect us from, especially digital tyranny, in a way that we are so lucky that this has been put forward for us to use. And, part of my thesis is that, I have Bitcoin partly for this type of flexibility, that full permissionless individual empowerment gives you. It gives you a type of mobility as well with your wealth that is just unprecedented. And for those who have read The Sovereign Individual, it's prophetic in the sense that all the European governments in particular are moving in the direction of trying to shut in capital if they can. And obviously Bitcoin resists that to the extreme. Gotcha. So, I'm all for that. I personally, I think it's going to perform because it's an adoption story. It's a strictly limited good with a potentially huge, as of yet untapped user base. We estimate Bitcoin has around 500 or 600 million users. That's not even 10% of the global population. Okay. So we still think that there's quite a lot of adoption to be made, and the gain, a lot of the gains come from there. A lot of people want a part of this limited technology, and there's only so much of it to go around.
I mean, that's a very good segue into Noah's question, which is, how do you determine the real value behind a cryptocurrency, for example, as a medium of exchange or for data transfer, and how can you use that to decide whether it's a worthwhile investment, or is it mostly driven by emotions? Is the end of that question.
Right. Well, value is subjective. Yeah. So anything is worth what a purchaser is willing to pay for it. So Bitcoin is an exchange good more than anything. It has qualities that make it very suitable to be a form of money, but not really much else. Okay. And I think that's a strength. It makes it very clean, and it makes it. There's not a lot of price signal pollution in there. Mm-hmm. People use it for storing and sending value, and that's it.
Okay.
And I think that's very powerful. There are other cryptocurrencies out there that have different value propositions that place themselves as the kind of the fuel you need, if you will, to execute certain distributed code, and that's a different value proposition. Mm-hmm. And for you to determine what is a good fundamental investment thesis, you first need to determine what do you think the thing you're buying is going to do. Yeah. And so for Bitcoin, I think it's going to take increasing share of the global monetary market. and that's a 200 to 300 trillion market. And the current value of Bitcoin is like right north of $1.5 trillion. And so we're not even 1% into that market share.
Yeah. Okay.
As for the other cryptos, you gotta look at how they're structured, because they often have much more complex structures. So if we take Ethereum, for example, it has a structure whereby increased usage of the actual blockchain itself for useful things creates deflationary pressure on the issuance.
Yep.
And so there you gotta make your calculations. What is the total market that you see Ethereum taking in terms of value creation? What value is going to be created here? Why are people going to use it? How much money do you think they're going to send through this thing, and how much fees are they going to pay? Fees paid is, more or less, I think it is equivalent to the amount of coins burned. And then obviously you looked at, or I shouldn't say obviously, it's a bad word, but then you weight that up against the issuance via the staking. And so you can get there a balance between issuance and burn to get your net inflation or deflation rate. And so there are ways that you can see whether, or you can, it's all modeling, right? You don't know how people are going to behave in the future. Just because something is deflationary doesn't mean that demand will come.
Yeah.
But if you make sure that all your assumptions are at least workable or believable to yourself, you can model your way into seeing whether the crypto that you're holding has a shot at growing vastly beyond the levels that it's currently at, given future use.
But I think those are some helpful frameworks for sure. And then David's question is a bit like the elephant in the room, but I think an optimistic view on it. So baby elephant, which is, thanks for hosting this event. You're welcome. I just found out that the rules have changed, so I can't buy crypto ETPs in my ISA, but I can hold since I've already bought. Is that right? How does that affect holders and buyers? And can I or should I hold outside an ISA, or what are the alternatives? So a lot in there from David.
Well, so my personal experience here is that different providers are interpreting the rules differently.
Okay.
And so my provider, for example, said we're interpreting the new rules such that you can't hold and you're going to get auto liquidated. Another provider at the office that one of my colleagues has said, oh yeah, no, you can hold and that's fine. And that was the old state of affairs as well before October last year. So some of us had held these ETPs since I think 2021, even though you couldn't buy them, you could still hold them. Honestly, it's a little bit. I can't vouch for how different providers interpret these rules. Whether you should hold it outside of an ISA. Look, ISAs have limits. You can only put so much money in, right? And if you're doing any investment outside of that, you're outside by default anyway. So obviously everybody prefers to pay as little capital gains tax as possible. That is just the way it is. Whether you should hold it outside, it all depends on whether you think the risk reward makes sense for you, and what's your investment horizon. It's hard for me to I can't answer this for individuals.
Just to again, tax treatment depends on your individual circumstances and maybe subject to change. To quote the all important disclaimer.
Also true, but certain if. Again, it comes back to what do you believe the performance is going to be like? Because if the performance is such that you'll be happy anyway, then not being able to hold it in an ISA shouldn't affect your.
So maybe we're coming up on time. I want to squeeze in one final question from Abby, and then I'm going to shoehorn in another, which is Abby's question is. It's the $1 million question. What will Bitcoin hit by the end of 2026? What's your prediction? But maybe can I just tag on to that? What are the one or two practical things that you want people to take away to think about figuring out crypto for their portfolio right now?
Yeah. I don't know if I'm allowed to give price predictions.
Okay.
What I can say is that
Just hold up fingers.
Yeah, we have a couple of valuation models that we use. And the model that we use to find bottoms of the market, basically where the fundamentals tend to hold up the market even during bad times. That model would suggest that at the end of this year, if Bitcoin adoption continues at the pace that it has on average over the last 4 or 5 years or so, I don't remember exactly, we should be bottoming out if there is a bottom this year. You know, the market swings in ways that we can't predict, but
and like you said, there are assumptions built in.
Yeah, exactly. But based on the assumptions that we have in that valuation model, the kind of bottom level fundamentals suggest a little bit north of 100K later this year.
Okay.
At I forget how many, 650 million Bitcoin owners, something like that.
Cool.
Yeah,
maybe what's the practical step somebody should be taking to really get to grips with crypto for their portfolio right now?
Well, you need to determine your risk tolerance because crypto positions are highly volatile. So the first thing you need to do is you need to get comfortable with how much risk you can tolerate. And we normally, when we do our portfolio analysis, we normally start from there and we work our way backwards. And we say that if you can tolerate, say, an additional 100 basis points of volatility in a year, you should have a Bitcoin position of X%.
Okay.
And I think right now the numbers that we have in our model is for each additional percent of volatility. I think the proportion is something like 6% of Bitcoin.
Wow.
So, but with that, via our backtest, you do get a largely improved Sharpe ratio and significantly improved overall returns as well. So, it all has to do with how much risk are you willing to take? Where are you in your investment career? The younger you are and the earlier you're on, the more risk you normally should be able to tolerate.
Yeah.
But this is an individual question. But this is where
absolutely.
you need to start, in my opinion, with your risk tolerance.
Sounds very good. Chris, we could go on for another 30, 40 minutes and people are sticking with us. And so I'm sure that is 100% true, but we have come up on time. Chris, thank you so much. It's been phenomenal hearing from you. I think I've learned a ton, really valuable stuff. And to the Finimize community, amazing. Thank you for tuning in. Chris, thanks again. And everyone else, we will see you at the next event.